In recent years, there has been a notable shift in the investment landscape towards a more socially responsible approach. Environmental, social, and governance (ESG) investing has emerged as a significant trend, driven by a growing recognition of the importance of sustainable and ethical practices in business. This video aims to delve into the core principles of ESG investing, explore its rapid ascent, and examine its impact on the financial markets and beyond. So, what exactly is ESG investing? ESG investing involves integrating environmental, social, and governance factors into investment decisions and risk assessments. Investors evaluate companies based not only on their financial performance, but also on their broader impact on society and the environment. The goal is to allocate capital to companies that demonstrate a commitment to sustainability, ethical business practices, and responsible corporate governance. So first, let's talk about what constitutes environmental factors. Environmental criteria assess a company's impact on the planet, including its carbon footprint, energy efficiency, resource usage, and waste management practices. Companies with strong environmental performance may prioritize renewable energy, reduce greenhouse gas emissions, and implement eco-friendly initiatives. Now, moving on to the social factors. Social criteria evaluate a company's relationships with its employees, customers, communities, and other stakeholders. Factors such as labor practices, diversity and inclusion, and human rights are considered. Companies that prioritize fair labor practices, employee well-being, and community development may score higher on social criteria. And last but not the least, we are going to discuss what constitutes governance factors. Governance criteria focus on the quality of a company's management, board structure, transparency, and adherence to ethical standards. Strong corporate governance helps mitigate risks and ensures accountability to shareholders. Factors such as board diversity, executive compensation, and anti-corruption policies are taken into account. And now, shedding some light on the rise of ESG investing. The surge in ESG investing can be attributed to several key factors. And one of those factors is growing investor demand. Investors, particularly millennials and institutional investors, are increasingly prioritizing sustainability and ethical considerations in their investment decisions. They seek to align their portfolios with their values and beliefs, driving demand for ESG-focused investment options. Another factor that is contributing towards the surge in ESG investing is risk mitigation. ESG factors are recognized as critical indicators of long-term sustainability and resilience. Companies that effectively manage ESG risks are better positioned to weather environmental, social, and governance challenges, reducing the potential for financial losses and reputational damage. Another critical factor contributing to the rise of ESG investment is regulatory and policy support. Governments and regulatory bodies worldwide are implementing measures to promote ESG disclosure and transparency. This regulatory environment encourages companies to improve their ESG performance and provides investors with access to better quality ESG data for decision-making. And the last factor on our list that is responsible for the surge in ESG investing is enhanced financial performance. Numerous studies have shown a positive correlation between strong ESG practices and financial performance. Companies that prioritize sustainability and responsible governance often outperform their peers over the long term, attracting investors seeking both financial returns and positive societal impact. Okay, so we know ESG is all the hype right now, and companies with a focus on ESG are attracting smart investors' money. But the question is, what are its impact on the financial markets? The rise of ESG investing is reshaping the financial markets in several ways. First, let's look at capital allocation. ESG considerations are influencing capital allocation decisions, directing funding towards companies with superior ESG profiles and away from those with poor ESG practices. This trend incentivizes companies to improve their ESG performance to attract investment. Next is shareholder activism. Shareholders are increasingly using their influence to advocate for ESG-related changes within companies. Proxy voting, engagement with management, and shareholder resolutions are common tactics employed to drive corporate sustainability initiatives and enhance shareholder value. And last but not the least, we have financial products and services. The proliferation of ESG-focused investment products, such as ESG funds, green bonds, and sustainable indices, provides investors with a diverse array of options to incorporate ESG considerations into their portfolios. Financial institutions are also integrating ESG criteria into their risk assessment and lending practices. To sum it all up, ESG investing represents a fundamental shift in how investors evaluate companies and allocate capital. By integrating environmental, social, and governance factors into investment decisions, ESG investing aims to promote sustainable development, mitigate risks, and generate long-term value for both investors and society at large. As the momentum behind ESG investing continues to grow, its impact on the financial markets and corporate behavior is poised to reshape the investment landscape for years to come. And that's all we have for you today. If you wish to learn more about such topics, please click on the like button and subscribe to our channel. Thanks for watching.